Stop loss is 1,000 ticks, and you have $100 in your account, and each time it moves one tick, you bet at a lot size of 1 penny. So 1 penny times 100 is $1. So every 100 ticks, you'll lose $1. You'll be down $1. So I'm gonna write it out too. So lot size. Let's say you put 1 penny for your lot size, and then it's gonna go into leverage in a second. 1 penny, 1 lot size equals 0.01. So if lot size equals 0.01, then stop loss being 1,000 ticks would equal $10. I just did the math for you guys, but when you take the risk management course, it's going to get your math up to speed to where you're able to just do this quickly. You have the calculators that give you everything, Excel sheets, so you can just type in numbers and do it really smooth and stuff. But having the math helps a lot when you're dealing with big numbers. You're gonna have $1 million accounts and stuff, $2 million accounts. So it's really gonna be impossible. This math right here that you're learning is, I don't see no one teaching this on YouTube, and this is actually what helps traders grow accounts. That's why they say you need a mentor. I learned this from my mentor. So stop loss is 1,000 ticks, your lot size is 0.01, so that means your stop loss is $10. So you got a $100 account, stop loss is $10. So now that means you risk 10% of account. And you guys see how small this trade is. Like, it's very small compared to the trade we caught over here. This trade is very, very small. So different brokers use different tick sizes, but it's very important to understand that. Make sure everyone can see it. So now you're risking 10% of your account per trade. So now if you lose 10 trades in a row, you blow your whole account to zero. And what our signals, you don't lose 10 trades in a row, but if say you're trading by yourself, you just learn your method, you don't know how accurate you are and stuff, you know that you can only afford to lose 10 trades in a row. Most traders, they go to increase their lot size. So the first thing they do once they start, they're like, 1 penny is too small for me, I'm gonna go with a giant lot size. Every trader wants to use the $1 lot size. And when you have 1,000x leverage with a $100 account, it allows you to use the $1 lot size, because they know that if you risk more, you're gonna lose and you're gonna be giving money away to the brokers. Think of trading as like a casino. Like, it's a casino, it's a game of odds, a game of math, and these people want to take your money. The house always wins. Like, if you go to a casino, the house always wins. So now you want to become a house. You want to become your own house, your own casino, and you want to go inside their house, being a house, so that you always win. So you want to create your own edge, your own odds. That's why over here in the risk management mastery, I teach you guys how to become your own casino, beat your odds, build your own edge, and everything. It's very important to know. I can't stress that enough, but you want to become your own casino. So now your lot size is $1. So now your stop loss being 1,000 ticks, it just increased 100. So now your stop loss equals $1,000. You got $1,000 stop loss, and now you're risking. You can't even risk as much. You can't even afford to lose one trade. You can't even sit through a trade, and you're never going to be able to grow an account like this ever. Like, you will never ever be able to grow an account. And this is how 95% of traders lose, and how they're never able to grow an account any size, no matter what. Some traders become boom and bust traders. They go up, make money, lose all the money, make money again, lose it, they just boom and bust. They'll hit a trade, then they'll the risk management and the psychology. It's not it's normal human psychology, but it's not top trader psychology and top trader risk management. Traders, if trading was easy for normal humans, then everybody would be making money. But they make it hard for normal human psychology. Like, for example, let's as soon as you put money in the market, you automatically become emotional. And when you become emotional, you have two brains. You have a logical brain, you have an emotional brain. Once you put money in the market, your logical brain switches off and your emotional brain turns on. And then now you're making decisions with your emotional brain. That's why psychology is important to understand this stuff. The trading psychology course is very important because now you're trading with your emotional brain. You took out math. You don't know where your stop loss is. You don't know how much you're risking per trade. These things are going on when you're trading in your emotional brain, and your account is going to get blown. You're going to do things you're not going to, it's tough. It's really tough when you're training your emotional brain. It's tough. That's why I'm hoping this helps someone. I'm hoping this can help you guys because I don't want to see you guys make the same mistakes I went through when I was getting started out. But I think this covers the pips and ticks and leverage. So now when you're using a leverage account, it's good. You want to have the leverage in your back pocket. So you have your leverage sitting there. So now you know your leverage and you know your trades. So now let's say you set a trade. And then Bitcoin, it shows it really small. It is what it is. But now let's go into risk management. Knowing all of this, we can move on to risk management. Just continuing on from here. So, risk management. My bad. I normally use a little Mac computer. Using the Windows like different from me. So we're going to risk management. So when we do risk management now, we're going to use the same account size. We're going to take our $100 account. I'm going to teach you guys. Right now, you're learning how to grow a $100 account right now. So this is actually really, it can apply to any size account. So you want to take your $100 account right here. So you have a $100 account and you want to grow it. So now, to use proper risk management, you don't want to risk 10% of your account per trade. You can do that with the signals it gives. You can risk 10% of your account and you'll be able to grow your account. You'll be able to make money. But I like to risk 1 to 3% of my account because it gets me in the mindset of when I have $1 million. Say, once you get to $1 million account, and you guys are all gonna get here. Like, if you guys are watching this, you're definitely getting to $1 million account. If you guys follow me, if you're following the stuff I'm doing, you're gonna have $1 million accounts, no problem. In a matter of a month, it doesn't take long to get it. I teach you guys how to get funded. You don't have to go out and make $1 million. You guys are gonna get funded, and you're gonna be trading like pros. So you're gonna have this, and it's very important once you have these accounts to understand these things, because if you don't, you're gonna blow your accounts. So you want to risk 1 to 3% of your account. So in order to risk 1% of your account, or let's go with 3%. I'll use 1% for the math. 1% of $100 is $1. So now I go with my lot size. So I can only risk $1 per trade. So depending on the trade, let's say I want to say my stop loss, I want it to be right here. Even in inputs, you can put your account size 100. You want to risk per trade 3%. So that's what risking 3% looks like. that red bar right there. So you're risking 3% and you want to make so all the trades, my profit targets, I hit anywhere from 3x all the way up to 10x depending on the trade. I've been in bigger trades like 15x and stuff, but you want to take your money off the table. You don't want to just have money sitting in the markets unless you're like Warren Buffett and you're doing investing. But if you're being a day trader, you want to take your money. So now this is what a great trade would look like with risk management. So now my lot size would be, let's talk about risk first. I want my risk to equal $1. I have a $100 account. So in order for my risk to equal $1, that means my lot size has to be 0.01 for 100 ticks, or lot size can equal 0.10 for 10 ticks, or, and you can change it around now because now you guys know the math. Hopefully, I really like, let me know if I'm explaining it so you guys can understand it in the proper way. Like normally when I teach, I have to I use sheets, I have worksheets, I have Excel spreadsheets, I have a breakdown, I have all this already written down for everyone, for every lot size, PDFs and stuff, and the course and stuff. So let me know if I'm explaining it on this live properly. Or your lot size can equal, you can use your $1 lot size now, but you can only use it for 1 tick, which is nothing. So if I want to risk $1, because I know I want to risk 1% of my account, then my lot size has to be this. If my stop loss is 100 ticks, if my stop loss is 10 ticks, it can be this. If my stop loss is 1 tick, it can be this. So you can change around your stop loss now. You can choose what stop loss you want. You can switch it around. And this is so important. Like, I know it looks like math and numbers. And a lot of traders I've seen who I tried to talk to before, like everyone in my family and my nephew and stuff, like they know this stuff and they're able to trade and grow accounts like effortlessly. Most traders overlook this stuff and they're like, oh, show me a pattern, show me a candle, show me something like that. And it's an endless cycle. That's like the 7-year journey, I call it, of chasing patterns. Actually, I think you gotta be careful with patterns. I don't know, but just be careful because you don't want to bet your house on a pattern and then the pattern fails and you lose your home and you know, people commit suicide from trading. So be very careful with your trading. Make sure you're trading logically. You know, do your research and just understand the math and logic. That's why I'm going to try to teach you guys here, and then I also teach it in the courses and stuff. But anyway, so your risk is $1, and I want to make. Now this gets into risk management. I want to make minimum $3, risking $1. So that's your goal. Your goal is to risk $1 and make 3. Or you can risk $1 and make 4, risk $1 and make 5, risk $1 and make 6, make 7. But the reason why you want to do it like this is because of